have an opportunity to follow along. But while that's teeing up, because Zoom sometimes decides to take its own sweet time with things, I did want to share that one of the cool things that I get to do in my weird job is to collaborate with some of the really smart people who are in our community. And our the fella who's about to drop some knowledge for you guys is Jeremiah Hazemba. Jeremiah Remza. Sorry, I'm punting my words. Too much coffee. Jeremiah has been with us for a long time. He's a data scientist, and if you have spent any time in our community at all, he's super helpful and answers a whole bunch of questions. And so one of the things that I asked of some of the folks in the community is that if they had something that they really felt strongly about in terms of financial education, would they be willing to step up and share a little bit with us? And Jeremiah was gracious enough to do that. And we're going to talk today about something that is incredibly important, which is credit scores and how that can really affect your life. There's a lot of inside baseball there. So I am going to step out of the way and let Jeremiah steer here. But I did also lastly want to say that if you have questions throughout, we're gonna let this run. We've got a hard stop at 30, but we will make a little bit of time to answer questions throughout, and then we'll also pick them up at the end. So anyway, without further ado, Jeremiah, thank you so much, and the floor is yours, my friend.
All right, thanks, Kevin. I will start by sharing my screen, and we can get started right away. So, let me switch which screen we're sharing here. Ta-da. Okay, so you guys should see green screen's kind of blank right now.
Yep, we can see it.
All right. So we're going to be working on understanding credit scores, what they are, and how to improve yours. Um, we'll get into some of the nitty gritty. But as Kevin mentioned, my name is Jeremiah. My last name looks worse than it really is. It's just Haremza. Once you get used to it, it's not that bad. But I've spent over 10 years working for three major banks, one of which is one of the largest banks in the world. Most notably related to credit scores, worked in default optimization for KeyBank. And default optimization just handles things once customers go into a past due status. What's the best way to contact them and let them know? And then for the recovery teams, what's the best route for them to recover the most value? So optimizing those types of things, and credit scores are a part of that. So real quickly, what we're going to go over is a basic introduction. I'm sure if you're here, it's not like you haven't seen a credit score or you don't know what it is, but sometimes they're confusing. So we're going to go over how credit scores are calculated, the factors that influence credit scores, and improving and maintaining your credit score. That is, when we look at anything in finance, we're really trying to do two things. That is, make the number go up and not make the number go down. So that's what we're going to be focused on. Maintaining is not going down, and improving is getting that number to go up. And then we'll look at the impact of credit scores on your financial life and some other pieces where those credit scores are used. So first off, introduction to credit scores. You may have seen this before, maybe you haven't, but this is very, I don't want to call it old, but it's very persistent throughout credit for lenders and for borrowers. It's called the 5 C's of credit, and those 5 C's are character, conditions, capacity, capital, and collateral. And today we are only focusing on character. So character used to be, in the days of George Bailey and It's a Wonderful Life, would be an individual bank manager who knew you and would know that you are paying on your mortgage on time, so we should lend you more money because you're likely to pay again. But those days are gone. You may have some level of relationship, but a lot of that's been moved away as banking and lending system has grown, And today, your character is your credit history maintained by credit bureaus, and that's contained in a credit report. So on the side there, you'll see a couple of keys to better character. Those are an accurate credit report and making automatic payments. And of course, Sequence can help with those. You can also do those at individual creditors. Some of those, almost every creditor has automatic payments in today's world. So, just the basic definition and purpose of credit scores. Credit scores just quantify your eligibility for loans, credit cards, and other types of borrowing. It assesses an individual's credit worthiness. It doesn't matter if you think it does or it doesn't. It is how lenders are assessing you. Um, so that's important. We're just going to play their game to get what we need out of the system. A typical score ranges from 300 to 850. There are some models that score a little differently, um, but in general, most scores are in that range. Higher is always better. We're not playing golf, so lower scores are worse. Higher scores are better. And then it does have an impact on some financial decisions, what terms you can get when you borrow, can you get lower interest rates? And there are some impacts to housing options and job opportunities based on your credit score, and we'll talk about those later. So let's jump into how they're calculated. Um, so we have as our typical borrower here, Vicky Von Borrower, and she knows the system and how it works. And that system basically has four pieces to it. It has creditors, credit bureaus, models, and the actual score that comes out. Vicky also knows that the only place she can interact in that system directly is her financial activity with a creditor, that is applying, accepting or denying credit, borrowing, and repaying. That's what her financial activity is. There are a few other places that we won't get into a lot, as far as liens and judgments and bankruptcies. Those can affect your credit score, but we're going to assume that those are for another discussion. She also knows that she can monitor her credit with the credit bureaus. She does not have to pay for any credit monitoring. She can if she chooses to, but she does not have to. Um, those are the only two places that she can interact. The rest of the system is up to the creditors and the credit bureaus. So, and the model developers. So we'll get into those, who's in the system, what they do, but essentially it's credit bureaus, model makers, and creditors selling each other products back and forth, to be able to get a score on an individual borrower like Vicky. So creditors, I'm sure you're familiar with who these people are: banks, credit card companies, mortgage lenders, retailers, student loan lenders, and nowadays the popular buy now, pay later services. Um, just make sure that you understand you are not dealing with Visa and MasterCard. Those are networks that process payments. You are dealing almost always, in some case, it will trickle back to a bank somewhere. And as I mentioned before, there are some non-creditors that can put items on your credit report, and there's a court process for that, for liens and judgments. So credit bureaus. I'm sure you guys have heard of these three credit bureaus. We're not really going to go over the history. They offer almost all of the same things. It's just a sales game to the creditors. So Equifax, Experian, and TransUnion offer almost the same things. They're going to name their products different that they sell to creditors. Um, and it's just a service and sales game that they play. If a bank feels they're getting a better result from Experian, they're going to use them. If another bank feels that they're getting a better result from TransUnion, they will work with them. So those are your credit bureaus. The thing to keep in mind is that creditors do not have to report to all of them. They may report to one, two, or three, but they do not have to report to all of them, so the bureaus can have different information. So models, probably the most popular model or model maker is the Fair Isaac Corporation or FICO. They have several models, some of which you will never see because they're only used by lenders. Um, some of which you will see, and I'm not going to go over all the models, but two things to note is right there, I have three listed in the chart, three more on the bottom. So those are six models. FICO 10, the FICO 10 suite breaks into two more models. And so we now have multiple lenders with multiple credit bureaus that they may or may not report to, multiple models that your credit bureau information can go into with different credit bureau information. So at this point, you can start to see the multiplicative problem of who has what data. The other problem is that creditors and credit bureaus are not required to report on any specific date. So they may all have different reporting cycles to the same bureau on creditors are reporting on different days. Credit bureaus are refreshing their data and sending scores back on different days to different creditors. And so it just leads to a lot of chaos as far as getting the same data at the same time on all the models from all the creditors and all the credit bureaus. The other thing to take a note of is older models tend to focus on what you did in the past. That is, if you failed to make a payment in the past, it's weighted heavier than on newer models are about how you will pay in the future. So they're more predictive. And those are two of their different selling points, but just keep that in mind. Uh, Another scoring system you see or model maker you'll see is Vantage Score. That was built by the three credit bureaus to compete with Fair Fair Isaac or FICO. They figured, well, if we have all the data, why don't we have the models? Why are we paying someone else to model and score stuff? And so there's just another set of models um, that they can, another set of products that they can sell to lenders. So we're just multiplying the problem of more data, more models with more numbers for you to worry about. So you're going to get an actual score out from those models, but anytime you look at a score, you should be looking for two things: the credit bureau that it came from. In general, when you view your credit score, they will be pretty transparent about where that came from, or you will know because you're at TransUnion looking up your credit score. Um, and you should be able to see the scoring model. So whether it's Vantage 3.0 or the FICO 8 or FICO 10 or whatever it is, you should be able to see those two things. So that's the basic model process. Any questions there? How are we doing, Kevin?
We don't have any yet. Again, guys, feel free to, if you have questions, drop those into chat and we'll pick them up when we've got a window here. But so far we're all just listening in, Jeremiah.
All right, so we'll go into the factors that influence your credit score that are inputs for the models to actually make that numeric credit score. These are general numbers, and I would take them mostly as ranking because we're not going into the nitty gritty of how a model works and the exact sensitivity to any of these in a given model. I would take these percentages more as rankings, but you will see these. You can look them up anywhere. You can run a Google search. You can ask Chat GPT if you want to use R1 DeepSeek. I'm gonna bet it's gonna spit out the same information. Um, but your payment history is most important. Your credit utilization is next. Your length of your credit history, new credit inquiries that you've made, and the mix of credit, the different types of credit products that you have on your credit report. We're going to go over these in detail a little bit here. So your payment history, this is the timeliness of your payments. If you have delinquencies, there are severities to those. And generally, those severities are marked as 30 days, 60 days, 90, and 90 plus. Uh, there are public records that may affect those, as I mentioned before, like bankruptcies, liens, and other judgments. The frequency of late payments. So if you have one late payment on one account that's 30 days, it's not going to affect you as much as a 30 days across every account that you have, or or a set of late payments on one account 30, 60, and 90 in a row. The other thing to be aware of is that these do compound I would say exponentially, but I use that figuratively. Um, that is, if you're 30 days behind and you get to 60 days, you now have to pay three payments to be back on track. That is, you have to pay your current payment, you have to pay your 30 days past due payment, and you have to pay your 60 days past due payment. If you miss another one, it just gets worse and keeps compounding. So the sooner you can take care of any delinquencies, the better. Uh, Length of payment history. It's going to be on your credit report for each individual creditor for 7 years. And just be aware when we get to length of history, your credit accounts will stay on there for 10 years, even if you've paid them off. So if you've paid off a car loan 5 years ago, it should still be on your credit report today.
Hey, Jeremiah,
Uh,
we've got a quick question. Can I throw one out at you?
sure.
Okay, so Howell asked if you have a discrepancy between one of the credit bureaus comparable to your score in the other two, like basically he's asking why is that and how would you go about fixing it? So I don't know if that's a broad question with a specific answer, but basically of the three bureaus, if you've got one that's weird, how would you go about attacking that?
Yeah, so you can always file a dispute, but you can't, it's not like disputing who broke the lamp with mommy. It's you're going to have to submit a written report. You're going to have to submit documentation. If you have no documentation of the payment, it's going to be harder to get that through. But I do have resources at the end of this that Kevin is going to have a copy too that he can post. But you can go to any of the credit bureau websites, whatever credit bureau that is. So, for example, if it's Equifax, just go to equifax.com and they'll have a dispute process and you can submit everything there. I have done that process myself. I did have a similar problem where one lender reported me as late, the other, it was not late on the other two reports. I did have a payment receipt, so I submitted all of that documentation and it just automatically they took care of everything because I had sufficient documentation and the lender didn't have anything to dispute back with. So lenders will be given a chance to dispute back as well.
I've got one more quick one, and I think you answered this already, but Cave may not have been here when you did. So the question that he asked is if a credit score is when a score is shared, is there a requirement to show the model used? It sounds like maybe that's the case based on what you were saying earlier. And all the ones that I have seen disclose the model, Cave says, I was uncertain if that is regulated or required. So anyway, can you just speak to that one more time?
Sure. So usually you will see it. They try to be pretty transparent now. Some of it you might have to do a little detective work on just looking at pieces of what's reported or what's on the screen. If they're not super clear, you can always ask too. I know that's a pain in the butt. We want everything given to us, but you can always ask. They will usually be able to tell you. Um, there shouldn't be any reason that it's hidden, but to my knowledge, I don't know that it's regulated that um, they display where that's from.
Awesome. Thanks. Go ahead.
All right. So as far as strategies with payment history, you can set up automatic payments, like I mentioned before. You can do that with Sequence. You can do that at your lender. Um, it's only the minimum amount that they're worried about. So if you can only make the minimum amount, great, do that. You're not going to get any extra credit for paying multiple times, and you're not going to get any extra credit for paying the balance in full, but you should pay the balance in full. That's a separate discussion. Address missed payments quickly, and as backup, you can have an emergency fund. So bonus there, you always have a past due window. So if you are 2 days late, yes, you may have a late fee, but it will not report to the credit bureaus. So get that payment in right away, and you can ask for a late fee waiver. Usually there's a 12 or 24-month window, so use those sparingly. All right, so credit utilization. This is usually across either a single lender. You can look at this, say a single credit card, or you can look at this across your entire portfolio of lending, all your credit lines versus the debt outstanding. It's a fraction debt outstanding over credit line. So how do we get credit utilization to go down? You make the numerator smaller by paying off your debt. You make your credit lines larger by asking for more credit that you never use. So pay down high balances, request credit limit increases when appropriate, or apply for additional credit. Spread balances across multiple cards if you want to keep those balances down per card. And avoid closing unused credit cards. This reduces your overall available credit when you close those. So that's going to make your utilization go up anytime you close a credit card. Length of credit history. Unfortunately, you can't go back in the past and open more credit, but your only strategy is to keep credit cards open. You can sock drawer them, is the term in the credit card community, if you're not using them, and just take them out once or maybe a year or maybe once every 2 years, buy a coffee and put it back. The other thing to take into account is the account velocity, how often you're opening accounts and how fast you're doing that. Another 10% towards the end here is your new credit inquiries. Just be aware of the difference between hard inquiries and soft inquiries. A lot of credit card lenders and other lenders have pre-qualification systems nowadays to see which credit cards you are available to you or you qualify for. Those are generally soft inquiries until you accept the offer. Then they become a hard inquiry. Checking your own credit score, insurance companies that check, jobs that check, those are all soft inquiries. And again, account velocity matters here when we talk about inquiries, how fast you're opening. So just be responsible and understand how that works. Credit mix. So there is the last 10% is about have you had different types of credits? If you've only had one credit card, that's not much of a mix. But if you've had a mortgage and an auto loan or student loans, or personal loan, credit cards, what lines of credit, whatever you've had, as that mix goes up over time, that will increase your credit score. I would not generally suggest opening additional credit for no reason. And I would generally suggest that you only open credit that you can handle. But there are some advanced strategies on manipulating your credit mix that are probably beyond this talk.
Jeremiah, I've got one more
Yes.
question. Let me throw that out to you. Patricia asks, I thought lenders didn't want you to have too much available credit. Could you speak to that?
Yeah. So they generally, when you're talking about available credit, this is what they call revolving lines or non-amortized debt. It's anything that doesn't have a fixed payment schedule. So they generally, if your credit score is good, having more credit will help you, provided that you're keeping that below. If they deem you a risk, what will happen sometimes is you might have, say, a credit card with $10,000 credit line and they may reduce it. But if you show that you can pay, that you use it, they will keep those lines open generally. If you, on the other hand, you have $10,000, but you're only charging $100 a month, then that looks like you're never going to use it. And that's a problem. On the other hand, if you have had, say $5,000 on that $10,000 card at times, and you have paid that off responsibly, then they do want you to have those lines available. Remember that creditors want you to spend money, they want you to pay interest. If they give you no credit, you can't spend any money and you can't pay any interest. So they do have a vested interest in people who are responsible having sufficient credit lines.
Great question, Patricia. Just a heads up, Jeremiah, we're at 25 after, so I want to make sure you've got plenty of time.
Okay. So credit mix, it's just the different kinds of credit that you've had access to. Usually I would say credit mix is like pushing that last bit if you're like trying to break 800 or or something like that. Okay, so just quick review. Pay your bills on time, reduce credit utilization. I would generally what you'll see is 30% as the mark. I would say 30% is good, 10% is better, 5% is best. So, pay that off as you can, have credit that's more than what you'll generally use. Uh, Keep old accounts open. That affects length of credit history and available credit utilization, avoid opening too many accounts and doing it too fast. Uh, Keep a diversity of credit types, so take that into consideration, and then monitor your credit report because that's where all of this data is going to be stored as you make good actions. All right, so just to end on uh, impact your credit scores on your financial life. So whether you're going to get approved or rejected, that's probably one of the biggest immediate impacts that you're probably already aware of. You can get better borrowing terms, especially that will especially save you on things like a mortgage, where 1% can make thousands of dollars in difference over the term of the loan. If you're paying your credit card off every month, you may not care as much about the interest on there because you're paying it off every month, but it just gives you more options. So employment opportunities and housing, you can get better housing as far as location, maybe closer to work or preferred neighborhood, or maybe a certain school district that you want to have your kids go to. But some of that's going to be determined by your credit score because it'll determine what kind of mortgage you have, or renting rental companies or even individual landlords may check your credit scores for ability to pay. As far as job prospects, especially because I've worked in finance, it's common to pull credit in that industry. It's also common to pull wherever you have access to PII or personally identifiable information. Um, but um, employers are allowed to do that. You will usually sign off on that. So if you don't want that done as part of your background check, then you don't want to work for that company. It's also common in government jobs, but if you're getting a job for the CIA, I'm sure they know more than that.
I'm sure.
I did put some myths in here. I thought the weirdest one I came across was anybody that thinks your credit score merges when you get married. It does not merge when you get married. But if you have co-accounts or are co-signers, yes, it can affect the other person's credit. So, all right, that's pretty much all the information I have. Um, I mean, I have more information, but that's as much as I can get in 30 minutes.
So I have a couple of quick questions, and we'll pick those up, and then I want to make sure that folks know how to get a hold of you, and they also know that once this compiles, you guys, I am gonna. We have a space for event recordings in our Discord community. If you're not in there, certainly welcome you to join or send me an email at kevin@getsequence.io, and I'm happy to send you an invite. Two questions. David asks, um, and David, I'm reading your paraphrasing here, so if I miss this, just follow up. But 5% best, but 0% bad question mark. I assume that it has to do with credit utilization and the difference between closing accounts and keeping them open. He asks, can we automate the sock drawer method by passing subscriptions through credit cards that automatically fill them up, or will that flag something with the lenders? So basically, it sounds like a little bit of creative credit usage from David. Is that doable? Is it kosher? Thoughts?
Um, so as Yeah, so those percentages are not written in stone anywhere. Those are based on what I would say is anecdotal information from myself personally and other people in the credit card space. The 30, 10, and 5%. And then there was a question about subscription payments. I,
Yeah, yeah. There was a question about basically passing subscriptions through credit cards, then automatically filling them up. Like I guess it sounds like some sort of creative payment routing that would automatically fill up those credit cards. That will that flag something with lenders? I'm not, David. I may be butchering this, so if it needs clarification, feel free to jump in. Basically, he said, okay, basically not having to remember to use the credit cards now and then. So he's trying to automate,
oh,
making sure
yeah.
that those cards have a little bit of activity on them.
Yeah. So if you want to keep those cards active with an automatic payment, so I don't know, every September 1st, you get billed for an annual subscription to Amazon Prime or Netflix or whatever. Yeah, you can do that and that'll keep them open. You can keep the automatic payment as the full balance, and that should keep it active all by itself.
And then Hal asked, is it feasible to utilize credit cards for investment purchases in real estate? Now that feels like a pretty broad question, but could you put, say, I want to, I don't know, like buy some sort of fixer upper on a big credit line attached to a
Yeah.
credit card?
So, uh, if you let's stick with just credit cards, because there are other strategies, but generally you're not gonna walk into closing and swipe your American Express Black card that you pay $15,000 a month for and buy the whole house, right? But you can pay vendors with credit cards, right, for repairs and remodeling, that kind of stuff. You can also, some credit cards will offer you um, payment checks or deposits into your checking account at like 0% with for a 4% fee. They won't ask what you do with that money, so that's certainly possible. You can use that as down payment money. The problem is if you're applying for any other financing and that impacts your credit score. So that's the part you would probably want to be conscientious of.
Awesome. Really great questions, you guys. Thank you so much. You see Jeremiah's contact information on the screen. I'm going to follow this presentation up. It'll probably be either late tonight or maybe early in the morning. I'm going to send you like literally a 3-question survey just to see if this is helpful, if you have any suggestions that we can use in terms of formatting for other presentations. And then I'm also going to send you a link to the recording. So if you had to bail earlier, if you're watching on the stream and you want to get on the list and make sure that you can go through some of the many great tips that Jeremiah shared with us today, that those are available. And then again, just want to invite you guys to stop by Sequence Brain Trust Discord community. Hit me up at kevin@getsequence.io. We also have kind of a small Facebook group where we do a little bit of sharing as well called Black Belt Budget. Jeremiah, thank you as always, crushing it, dropping lots and lots of knowledge. I know this was a quicker session than we probably could go for, but I really appreciate you making some time for us today, and I hope this was helpful to all of you guys sitting in.
Thanks for the time, Kevin.
All right, guys. We'll follow up with you soon. Have a great rest of your week, and thank you.